Tonight is our 2020 ER series, presented by Cheddar Flow, a modern options order flow platform. Track and monitor option activity that helps you uncover institutional money flow, all in real time.
It's the middle of the week, and middle of the week videos call for middle of the week drinks. So here at Last Margin Call, we have a fancy cocktail recipe before we jump into our video today. We are doing a grapefruit old fashioned, and this is just to one-up Chaz, basically, just to kind of shove it in his face that, you know, we actually know how to do drinks just a little bit better. And not all of our drinks are shaken. We actually stir our drinks. So we have this lined up for you. It is a grapefruit old fashioned. In order to make this, what you're going to need to just put this all together, you're going to need grapefruits, you're going to need whiskey, you're going to need simple syrup, bitters, and you're going to need sparkling water to go with this. Once we hear it all out, let me know what you think in the comments. You can DM, you can message, do whatever you want with that. So you're going to do 2 parts grapefruit juice, you're going to do 2 parts bourbon, specifically Bullet. Don't do anything cheap. Don't do gin where it's going to be crazy sweet when it comes to this. 1 part simple syrups. You're going to do 2 dashes of a grapefruit bitters, which is great because it's a little bit candied, so it'll kind of cut the grapefruit juice down a little bit as well. And you're going to add a splash of grapefruit sparkling water, and that is a lot of grapefruit, and that's a lot of grapefruit to say all in one, so it's a little bit of a tongue twister. And then you're going to throw in your ice cube, and you're going to garnish with that grapefruit peel that you had on there. It's a great drink. It's better than anything Chaz can come up with, so I just want to make sure I reiterate that real quick. But we're going to jump into our 2020 ER series. This is video 2. We have video 1 from early on in the week. We had a couple people pick out the ones that we're going to do. We're going to be doing PG, which is Procter & Gamble. We're going to be doing INTC, which is Intel, and American Airlines, which is AAL, and we're going to be doing AXP, which is American Express. And before we jump into anything, you know, we always like to remind you just about what these videos are actually about. There's going to be no fancy talk. Everything is going to be broken down to the basic essentials of what these plays actually are, what they mean, and what you want them to do and look like. So it's kind of like you're understanding how to manage it at the same time, but we are not here to hit you with some fancy lingo to make you confused and make you just feel like options are kind of really stupid crazy. You know, we're not throwing out zebras, we're not throwing out jade lizards. I threw it out there. We want this to be something that sparks your interest for you to go out there and you to want to learn about this. All right, so take that with note. We'll always throw up the pictures of the actual plays. You're following the lines, and you're following the, you know, just on any graph that you have, you know, how much you make, what price it's going to be on the bottom, and then you just play it from there. So I hope when you do find these plays, I hope you find them useful, number one, but I hope it sparks your interest more than it actually does. You know, you're actually making money off this, because it's going to lead to future endeavors that you're going to be hopefully accomplishing when it comes to ER season. Here is we're going to be jumping into PG, and let me look that up real quick and we'll get this going. So PG, we're hitting 52 week highs on this, and it is in an insanely strong uptrend for the past couple of years. So, you know, the thing that you have to understand with this is, if it's in an uptrend for 3+ years, you know, your bias kind of should been leaning a little bit bullish here, because, you know, you're not trying to call market tops with this and run put verts down. You're not trying to grab puts all the way down because this is the top and you want to grab that. So the whole point about this is trying to find plays that can play within this move itself. In the implied move, I want to say is it's going to be, we'll just put it at $4. $4 is what the move is going to be. Trading at 126 currently today on a Tuesday. And so you have an upside to 130, you have a downside to 122. So we're going to play within that, and we're going to find plays that fits this, that allows you to not care about what happens on this report. You don't care if they miss, you don't care if they do anything, you just want it to fit your bias, and you want it to manage risk as best as possible. So let's jump into what we have planned for these names. The first one for PG is going to be the lovely Iron Condor, because we love to sell premium on these things, because people always want to jump at the ability to grab the super far out the money play, whether it's call or puts, and they want to be able to boast on Wall Street Bets, Twitter, wherever they're at, and just say, look, man, I just made $44,000 after I put in $100 or something wild. But we know that that never happens, and most of the time they lose all that in the next play because they think they can repeat this. So we're playing within a range of 130 and 122, and we're playing that Iron Condor within that range. So when we pull that up, we're going to be looking at the strikes. It's going to be, for anybody that wants to follow along real quick, it is a 128, 129, a 122, 123 Condor, Iron Condor. When it comes to that, I'll have it all on the screen. You'll have the dates up there, you'll have the strikes, you'll see which ones I'm selling, which ones I'm buying, and you're going to be playing through that. So when you have that pulled up, you're noticing that, you know, you're collecting 88 off this. It's an $88 credit. All right, you have your downside. You're seeing when this is going to go against you, when it's not going to go against you, by following that blue line on the screen. Right now it says you're at a $12 loss if it goes above 129. All right. When you're looking at 129, you know, that still fits within the range of that implied move. So good right now, because taking anything outside that could be going against you really hard, or it's a sucker's bet. So play within it. So we have a max at 88 across, and your 88 starts at about, we'll just put it at 23. And your max goes all the way to 128. So between 123 and 128, you are collecting $88. You don't care if it misses, you don't care if it drops, you don't care if it stalls. You want that range because you will collect the most. Now it falls off pretty quickly, but you're only losing $12 on this. Not a lot at all. $12 you're risking to make 88. So you're looking at, you know, some pretty triple digits percentages to the upside on this win, and you don't have to only play one on these. You can play 10 lots, you can play 5 lots, you can play however money you want. Just understand liquidity when it comes to this. Look, when you hear the word liquidity, it means if I'm trying to get out of this, I don't need to leg out of it necessarily one by one, because you may jump into that, you know, if this is popping up to 127 and it stalls there or something, you may find it really difficult to get out of those puts because the spread is a little bit wide, and you're now giving up $8 to get out of one leg and $5 to get out of the other, and then all of a sudden, you know, you're chipping away at that 88, and all of a sudden you just collected 60 off that. So understand liquidity when it comes to this, and the ability to get in and out of your spreads. All right, so that's the Iron Condor that we had. It's pretty decent, especially when you're hitting these things when you're in a euphoric run up of the market itself. You're not following the wave entirely, but you're leaving a big enough wave to the point where even if this beats and this pops off that, you're still collecting that. But at some point, you know, some people are going to be not taking as greater risk when it comes to this. It doesn't mean it's not going to pop. It just means they're not going to go all in and hope for, you know, boom, we're going to blast through all-time highs and continue, and that's the only option that we have. So you play for a little bit of downside as well, just in case it goes against you. The other one we have is a calendar. You'll notice that the last video had a lot of calendars as well. This one is a 128 put calendar. For, you know, you're going to be selling the 128 put this week, so you want that to be bullish, so you want that to get above 128 this week so that you can collect all of that. All right, and then next week you also have a 128 put. So let's say you leg out of that one and you collected all of 128, and you're now in a 128 put on that, and all of a sudden market conditions go against it, you know, something else happens in the overall thing. You're now in a 128 put that you have free range like you're there. It could go drop down, or you can just leg out of it entirely and just call it quits and take the money and run with it. There's different ways to manage these trades when it comes to that. You're only putting up 33 cents for this. It's really good. And it handles all the way down to 122, which is well out of the implied move this week. And you're up to 134, which is also well up there. So you have a good range there. You have a $12 range to play with. Obviously you want it to land on 128 and collect all of that, but that's okay. You know, we don't need that. You can still make money off of the other things. You know, even if this landed on 124, you're still making $30 per contract. Even this landed on 131, you're making $50 per contract on there. So that's the beauty of calendars on there. It gives you a wide range to play with, and you're not overly scared about what direction it goes into. It just means that you don't make as much, but still needs to be managed accordingly, even if this goes against you pretty bad. But the downside risk is, I think it's about just 33, right? Yep, 33. So not much at all. And these are two plays that still fit within this implied move, and you have to just expect that, if they just blast earnings out or they absolutely dump on earnings, no one really knows that, or they would have been taking positions all along. So play within this move, collect that, move on. And next one is going to be Intel. We have two plays. One I'm not overly excited about. I don't really like it because there's a lot of downside risk, but it gives you a multi-directional bias on it. And so when you're looking at the implied move for this week, this is one I kind of wanted to really talk about, and I hope everyone's listening to this side of things and made it this far. You're looking at a $3 move on this, trading at $60 currently. So you're looking at, maybe we'll just put out 64. We'll call it good, 64. All right, and then you have a downside of 57. But that's the implied move. But when you look back at these earnings reports that they've been having throughout these weeks, it blasts and it moves. Whatever direction it does, it is going to move. And you're talking like 10% moves. And this implied move is not really 10%. You're looking at about a 5%. We'll call it 5% on that. And so that's the thing I was struggling to come up with in trying to find a way, you don't want to be one directional, that, it needs to just utterly dump or pop on this for you to do that by getting a debit vert or, a put vert on this, and just playing off that. And you don't want to be selling necessarily these verts on this and getting credit spreads, because of that history of it being able to move 10% off of these ER plays, because instead of collecting, you just may instantly be down the full amount on that credit spread just because of that 10% pop and drop that it has. So it was a struggle to find these types of plays for this, because you don't want to put out there something that's really bad, or just oh yeah, I just think it's going to go down, so I got this vert, or I got this back ratio. Maybe a back ratio would be good here, but it became too much downside, or even if it was I think it was at 60 or something, that for one of the back ratios that I was kind of looking at, but it would still be directional biased on that, and not really an ER play, I would say, that kind of gives you the edge of being unbiased, undirectional when it comes to this. So what we had is a broken wing butterfly, and let me pull that up real quick, and it's the 60, 61, 63. If you don't know how to construct that, you're going to be buying the 60, selling 2 of the 61 calls, and buying a 63. So when you're thinking about that, I'm selling 2 61s. I want to collect that money, but I want to protect that if I'm going to be trying to collect that money. So I'm going to be buying on the edges of that. So a 60 and a 63 caps that. It's going to let me basically be exposed to that, but I make the most money if it stalls off on that 61. So that's how you go into butterflies, and it's a stalling strategy that you have, that when this happens, you're going to collect all that money, move on, but you want to find a way to protect that different than just full on. I want it to pinpoint it here, and you have to have pinpoint accuracy on an ER, which I don't think anybody has pinpoint accuracy. So it's kind of foolish to play these. So that's why we come up with a broken wing butterfly on this, because a broken wing means that it's going to be lifted up, or it's going to be tilted down a little further in terms of your profit. And you'll see it on the screen on here that it's going to favor a bearish perspective of, it gives you upside, and it gives you about a it's like a 62.50 we'll put it at, where you start losing money. So it gives you about a 5% upside where you don't lose any money, but it's gonna make you money regardless if it goes down. No matter if it goes to triple zeros, you're gonna be making $23 off that. Now, if you add 10 contracts to that, that's 230. If you get the move, that's 1,100 that you're gonna be making off it. But if it goes above 63, you're going to be losing $750 off that. So, it's just all the different lots that you're playing. So don't think just because, I'm only making $77, it all depends on the contracts you're taking. And I think that is the giant misconception that I've been having with DMs that are flying in is, why would I want to take this? I won't be making that much money. Well, of course, if you're only taking one, it's not going to be that big of a deal for you, but who cares? You're playing probabilities here. Take accordingly. Take what the risk management that fits you. The other play that we have besides that broken wing butterfly, we have a double diagonal. Let me pull this up real quick. There we go. So this gives you a wide range. The downside with this double diagonal is going to be big losses if it moves beyond that 10% move, which it's known to do. So it's not necessarily an Iron Condor when it comes to this. So what I did here is I took the top end of that implied move, I created one diagonal. I took the bottom end of that and I created another diagonal. So you got your Batman helmet when it comes to this, and it's going to be the U shape in the middle. So if it stalls out right where it's at today at 60, then it's just going to be roughly, we'll call it $50. All right. You're going to be making money all the way between 54 and 66. And when you see that on the chart, it's a huge move, but it's known to make these moves. So don't be upset if this goes against you, because it's known to make these moves, but you'll never find the perfect play that just is unbeatable, or everybody in the world would take this, and people that have been trading years and years and years would have already saw this already. The good news about this double diagonal is that you have historical support that lies right there about 53, and it's pretty heavy. It's pretty heavily contested around that area. So even if it drops all the way down there, you're probably going to see the stock find support there and probably bot up and pop a little bit. And you only have 2 days left on this, so you just got to get it above 54 at that point. So completely plausible. And you have 66 on the top end, which is a huge pop for it, just a massive pop when it comes to that. And I know it wouldn't hit all-time highs, but it would be close up there. But I think that's a great trade. I really do. And if you never put on a diagonal before, it's different strikes. You're selling one this week, the 24th week, and you're going to be buying the next week, which is the 31st. And so that they're at different strikes, whatever you find to be that. And you're creating, basically saying, I want to collect whatever happens this week, because whether it be you grab a put because you think it's going to be bullish, or you grab a call because you think it's going to be bearish, you're selling it, which means you want it to go the opposite direction of what a call and put is necessarily. And then you're buying the other one for protection or playing it in general. It's a $5 credit when it comes to this. And when putting this on, you're going to be buying the 65 call for next week. You're going to be buying the 56.5 put for next week. You're going to be selling the 64 call for this week, and you're going to be selling the 57 put for this week. So, and you'll see it on here. It looks like a Batman helmet. It's great. You're going to be making good money on it. The downside is if it's hit 72 for some reason this week, which if it hit 72 this week, I mean, we got other problems, but it's going to be $95 loss, which it shouldn't be that much to a lot of people. So, and you have an upside of $100, and you have an upside on, if it hits the 64 mark, and you have an upside of 115 on the 57 side of it, with a downside of only 44. I think if you're using Robinhood, it'll be like a $100 collateral to put on this trade. So don't think it's just going to cost you $5. So 105 or whatever it is that they'll do for their thing. So that's what you'll need to put it on. I think it's a great trade. I am considering it myself. I think you'll like it. I think I'm kind of crazy for it when it comes to this. And that is, Intel is Thursday after the close, so you have 1 day left on that. So I would, that's what I do with my trades this week. I kind of put them on right now just to make sure I can get into them, no matter. I didn't want to fear about liquidity or my broker not filling me. So I was just like, screw it, I'm overbidding, I don't care. And I took, I think it was like $20 or just $30 extra overbidding just to make sure that I get into these plays. Obviously, the upside on there is like multiple hundreds of dollars. So if I nail every single play, and even if I nail one, it just offsets it. So that's okay. And then our next play is AAL, which is American Airlines. Airlines have been doing good. I mean, we had United, which, you know, we have to talk about the macro side of things. All right, first is we have the whole SARS outbreak, and it now reaching the U.S. and I think the fear is that people are going to be grounding flights or restricting flights, which is going to hit into profits, which is going to do all these other things. Personally, I think it's all just a scare tactic. It typically never results in anything major. There's not going to be long-term groundage of flights to certain areas, and you have to also think about where these flights are coming to and from, and what their main sources. Like if China flights are going to be their top thing because that's what everybody takes with them, then that would, I guess, would be a big hit on their sales, but that wouldn't even be reported yet. So I think you're looking upside on all airlines once again, even though after today, because of the huge massive drops that they have, I think it's overdone, overblown. I think it's an overreaction. So yeah, I am kind of saying jump into airlines. So with the two plays that I have put up on here, we have to first look at the implied move that comes with AAL, and I think it's a 170. Yeah, 170. Currently trading at 27, which means that you're at 28.70 for an upside, and you're at, we'll just put it at like 25 for the downside. Though that's your implied move for this week. All right, it is looking not as great as the rest of them, but I'm still taking a bullish perspective on this. And you know, if we look at the weekly chart on this, it's in a little bit of a downtrend that is patternized in a sense where it kind of looks like a fallen wedge. And if this breaks above it, it could really get moving because it's in basically a 2.5-year downtrend, and people could finally be giving up on their shorts and be looking to go long on this. And we, you know, that could be a good squeeze potential. Nothing is dated out, so this is just for this week when it comes to this. So if you want to look front month or beyond, I would probably be looking at the 2930s if you're looking for a longer dated bullish swing on this. But for this week, we have a 27, 28, 29 butterfly. Buy the 27s, sell 2 of the 28s, buy 129. The 27 and 29 are protection. You want it to stall out on 28, which fits into right along that falling wedge resistance line, which is just for this week. Remember, so it's, you have 2 days for that to play out, 2 days for it to not break out immensely and just explode. All right, and that's only $18 for that play. So $18 total you can lose. I believe the upside on that is, I mean, if you nail this absolutely perfectly at 28 and it's sold off on 28, you're like getting about 80. Realistically, you're probably looking at about 50s to 60s for your profit if it happened at that location. The other one, and this one is, it just doesn't move, and so condors aren't good, or they just don't work that as well because there's not that much to collect, and it's just not fun doing that. I didn't want to put on a calendar or anything just because it's just, I think when I pulled up a calendar on this, even if you went to this week on a 28 and you threw up a calendar, well, let's see, let's put it on. If you threw up a calendar on this, you're getting about to 26 to 30 this week. It's going to cost you 13 cents. And they would be selling the calls this week on that. So you want it to move above 28 this week in order to get that max on that. Downside was 13, max of 60. It's okay. It's just like, it's just another pinning tactic, pinning strategy of trying to make sure that you're making money on this, but also protecting yourself of any downside risk. So if you don't like butterflies on that, it's too pinpoint. You can look to diagonals, you can look to calendars on this. Just know your exposure to the following week, and if you think that, oh god, it's just going to drop but it's going to recover, maybe that's when you want to look at calendars, diagonals, because then you could start playing into, I now have a strike, I have a position for next week that I can work off of. So that's it for AAL. On there we have the implied mood set up on there. We have the macro news side of the, I'm still bullish that I think it's an overreaction to the SARS outbreak and everything. and everything's bullish for that. So if it drops down and pops up, make sure that you have a strategy that fits the drop down and pop up aspect of that as well. Last one that we have is going to be American Express credit cards. All right, they've been on absolute fire, hitting all-time highs, 52-week highs, 3-year high, weekly highs, doesn't matter what it is, making highs. All right, it's on a really good run, just broke out, but if you're looking at this from a technical side of standpoint, you got, a little bit of a bearish sign that people are kind of giving this up as it nears the top a little, but that doesn't matter about ER, that doesn't matter about sales, that's not feeding into it. All you know is that it's doing well, so people were buying it up, but you have no idea what this is going to mean. All right, so the problem that I had with AXP, American Express, was that collecting premium kind of really sucked on this one. It wasn't fun. I couldn't find anything that really went well with this, and it's just it had an implied move of $4. So you're looking at 135 possible upside, and you're looking at we'll just do 125, 135, 125 on this. So $10 spread on that. So putting that into a Condor, you weren't really getting that much money, and if you tighten it up a little bit, who knows if it just blasts off from that. And so it's too much risk to the upside. And if I took a Vert on this, the debit Vert, meaning that I'm giving them money, it's too much of a bias. So if I'm putting up a put Vert on this, then I'm too bearish on that. It just gives me that. It has to go down no matter what in order for me to make money. And same thing for calls. It has to go up for me to make money on that. And the problem is that they're reporting Friday morning as well. So you're not getting much time to work with this either. So, and you don't want to be selling credit spreads when it comes to this either, because it doesn't give you that much time, and you're not collecting that much either, because it is a Friday. You have, unless you put this on right now and you feel like it's going to move always in your favor, you're going to have one day to collect as much premium as you have with that. So it almost makes it forced to be a directional bias already as it is. So the only thing that I really came up with that I felt, okay, I'm comfortable enough putting this on, it fits a non-directional bias, I'm unbiased on what the company's performance could be, is a double calendar. All right, I know calendars are running hot right now because you're in a euphoric run-up of the market. All right, and who knows if it stalls out, who knows if it falls or if it continues. So you want something that kind of mimics that. You have no idea what it could do, so you want it to mimic if it could fall, drop, or pop. And you already know what those things are. Condors, jade lizards, calendars, directionals. Those are all the unbiased ones. It doesn't matter what you do, just play within those. So the 131 double calendar that I had for AXP, it's a 67 debit on this. And you're going to be making money. I mean, if it stalls out here or anywhere, is between 126 and 136. So a $10 move on this, and it is, what is it? It still fits within the range itself of the implied move, and it's actually perfectly lined up with it. It actually looks like, so that works out great. So just think right now, if it stalls where it's at, it's like a pyramid. Playing off of the implied moves of those things, and the further it goes down, it hits the base. All right, so the base is 125, 130, 136 for that move, and you can make a possible of 288, which probably won't happen. It won't stall out there, and things will change. So most likely what will happen if you take the realistic expectation of this going into this and playing a $10 move double calendar, the reason why it's a double calendar is it gives you more range. You're spending a little bit more, it gives you more range on that play itself, making it more for people that kind of have a gist of options, kind of like a butterfly, a more wide butterfly. I'm trying to make this as easy as possible so that you go and look into these things and what does he mean, what does he do. So I'm sorry if it's too basic for people that are have an understanding of this, but I want to spark interest for people. So this play is a 131 double calendar. It's buying the 31 call next week, buying the 31 put next week, but you're also selling the 31 call and put this week as well. So think about that. All right, you're trying to collect this week off of just a basically stalled move. All right, it doesn't matter what happens it's like selling a strangle. All right, you want to collect all that, and it's going to move within that range of where you bought from. So if you bought one side for $2, you bought the other side for $2, you don't want the price to move more than $4 or you start to lose money. All right, so you're buying the next week for protection, and you could essentially be rolling into next week, and it maybe in a volatile time with another strangle, So think about it that way. It's wide. You can make a lot of money off this. It's good. That's it for the plays that we have for this entire week 2. We have all of last week that are still playing out. I'm really biting my nails on the Netflix call that we have. If Netflix works out, all of the plays from Netflix will have worked out. UAL, United Airlines, is on the cusp of still making money, so I'm still holding on to that. We have Abbott reporting tomorrow. I never got into how, because you know what? I forgot it was Martin Luther King Day, and shame on me when it comes to that, but that's what we have. And then we also have TXN that still hasn't reported yet, and we're still running that double Vert, the double diagonal off that as well. So that's it. This will be the last you hear from us this week. Remember, you can always find us on Twitter, Messiah Theories from me, YouTube pages, Last Margin Call. Look into those, review those videos. You can follow along. I'll give you the real-time fills that we get on this as well. So if I don't get something, like I didn't get J&J, I didn't get a fill on that. That was really shitty, but that's okay. So you can always see where we actually got filled at, and I'll give you the breakdown of results that we get from that as well. But that's it for this week. We will hit you next week with whatever we have coming up. Hopefully we have a good time finding all the plays for this week instead of what was given to us a while ago. Even this week didn't even have, Earnings Whisper didn't even have J&J on there or anything else that was on there, so that was rough. So we'll see you guys next week. Enjoy. Good night.